Tax planning and tax strategy can kind of be a controversial topic between accountants. And I'm very far from being the most aggressive person in the world. I'll always want to do things by the book. I don't want to reduce tax at all costs because sometimes it's not worth doing. But there's like this genre of grumpy accountants that anytime you talk about a tax deduction, they're like, oh, it's not saving taxes, it's just deferring taxes, right? So the idea is like, if you accelerate depreciation on something, you're not necessarily saving the tax, you're just taking the tax early, deferring tax to the future. So this is true in some cases, but what I would argue is that you're not actually deferring taxation, you're deferring income. So for example, if you were to do a short-term rental tax strategy and you take all the as much depreciation as you can on the purchase price up front, say you get 30% of it, you are securing tax savings today based on your income and your tax rate. So if you're a high earner and you do that and you accelerate depreciation, you are locking in your tax savings, getting the present value of those tax savings. What you are deferring is income recognition. So in the future, you will have less depreciation to take against your income. But that doesn't necessarily equate to more taxes. And why is that? So say you're a high earner now and you're in the 37% tax bracket, but you plan to retire in 2 years. You won't have that earned income to be in that 37% tax bracket anymore. So if you recognize more income in the future, you could be in the 12%, the 22% tax bracket. So there's some level of arbitrage there. Another example is, say you do this with a property and you accelerate as much depreciation as you can. And if you don't own it in an S corp and you own it personally, you could die and your estate would get the stepped up basis in the estate and it would not have to pay depreciation recapture. So did you defer taxation? No, you secured tax savings up front. You accelerated depreciation and that tax was never paid because you got to step up in basis, or well, you didn't, your estate did. So yes, think through things to where even if you put money in a 401k, you are deferring income recognition to the future when you take it out. But don't listen to the grumpy tax advisors that anytime they talk about a tax deduction, they say you're just deferring taxation. You're deferring income recognition, which if you do it smartly can be extremely powerful and save you a ton of tax.